We believe that trend following might just be the most compelling alternative that an equity and bond investor can use for diversification. It's historically delivered equity-like returns at lower risk. It's delivered some of its best returns during the worst times for both equities and bonds, such as during bear markets and periods of rising inflation. And because it is more accessible now than ever before, it can be overlaid on top of existing equity exposure, meaning no disruption to equity exposure is necessary to reap the benefits of diversification. It just hasn't entered the mainstream yet. How's it, everyone? My name is Bruno. I'm a co-founder of Ironclad Asset Management, and in today's video I go through the 3 reasons why we think trend following should be considered to stand alongside equities and bonds in one's portfolio. If you'd like to learn more, please visit our website. A quick note, our videos are made to educate and hopefully to entertain and should not be taken as investment advice. But for now, here's trend following made simple. So what is trend following? Trend following is an investment strategy that purchases rising markets, sells falling markets, and profits from a continuation of those trends. The strategy invests in some of the world's largest equity, bond, commodity, and currency markets and uses futures contracts, which have the advantages of being highly liquid as well as transparently priced. But why does the strategy work in the first place? Well, there is extensive research that delves into why prices that are going up tend to continue going up and the other way around. Hurst and colleagues suggest that the answer may be rooted in how investors behave. Say an asset's price is going up on the back of some good news. A few early adopters might rush to buy the asset and drive prices up further. But the good news might not reach everybody at the same time. Or some investors might simply be less flexible to react instantaneously. So prices rise, but less than you'd expect. Trend followers would look to pounce and buy the asset at this point, always a bit late to the party, but betting on the trend continuing. Markets are fairly efficient, and over time, good news reaches more ears and less flexible investors begin buying. At this point, fear of missing out begins to take over, and even more investors pile in, driving the asset's price beyond what it is possibly worth in the first place. Unlike many other strategies that get crowded out when too many people participate, the strategy benefits from the bandwagon effect, exactly because this behavior exacerbates trends and therefore profits. Trend followers typically hold onto their position until trends are no more. So inevitably, once reality sets in and prices correct back to their fair value, they signal the end of a trend, a reversal, and trend followers closing their positions. So in short, the strategy does best when markets are trending, either upwards or downwards, and tends to underperform when trends suddenly and abruptly reverse, or in sideways bobbing markets filled with false starts and devoid of trend. So now that you know a little bit more about this strategy, let's get into why we think that it works so well alongside equities and bonds. There is extensive historical evidence supporting how well trend has historically done. To represent trend following, we use the SG Trend Index, which illustrates the after-fee performance of the 10 largest qualifying trend followers from 1999 to date. Trend following has delivered an impressive standalone return over this period, compounding at a higher rate than equity. And these returns have come with fairly modest risk. Its volatility was lower than equities was over this period, and its deepest drawdown, which is a measure of its worst peak to trough performance, was less than half that of equity. Looks good so far, but can we find more historical evidence? Hurst and colleagues backtested trend following strategy way back to 1880 and found that it never suffered a losing decade. This means that the strategy even managed to deliver in the toughest of decades, such as those containing the Great Depression, both world wars, and the highly inflationary 1970s. In fact, it shone brightest in decades with the most adversity. By the way, if you're enjoying this video, we'd really appreciate a thumbs up for the algorithm. It really helps. The second reason lies in just how useful trend following has historically been at offsetting risk, particularly during bear markets for equity investors and during periods of rising inflation for bond investors, while at the same time generating positive returns on average in bull markets and being uncorrelated the rest of the time. Let's have a closer look. As you can see, in each of the last 3 major slow bear markets, trend following has offset a meaningful portion of equity losses, making it a robust and valuable source of diversification. Remember, because it can hold short positions, it can profit from falling markets. Interestingly, it did not offset the COVID crash, which played out too fast for trend rules to respond effectively. Options-based tail hedging would have done a better job, and if you'd like to find out why, please have a look at our last video. But perhaps its most unique property is its track record of hedging inflation risk, which both equity and bond investors are massively exposed to. To show this, we group average historical returns by economic regime, rising and falling growth, rising and falling inflation. As you'd expect, equity has done well in rising growth regimes, and bonds have done particularly well in falling growth regimes, and both have done jointly well in falling inflation regimes. However, the strongest headwinds for equity and bonds in tandem has been during periods of rising inflation, such as 2022. And it is exactly during these episodes that trend following performance has been most impressive and most needed. We also see that this property is robust in history. Hurst and colleagues show that trend following would have had its best decade on record during the 1970s, a period of exceptionally high inflation, making it a tough decade for traditional equity bond portfolios to navigate, at least on their own. And that brings us to the final reason. Because the strategy is now more accessible than ever before, it could either receive a direct allocation simply by making space in a portfolio, or, one level higher, it could also be overlaid on top of existing equity exposure, so that no equity exposure is diluted. Let me explain. Here's how overlays work. Let's say an investor has a 100% equity portfolio to begin with. They might allocate, say, 20% to a trend-following overlay manager. The manager would then replicate the same 20% equity exposure using equity index futures. So far, so good. We began with 100% equities, we end with 100% equities. No dilution. But because the manager uses futures to replicate equity, he has unlocked enough cash margin to overlay trend-following exposure on top. This means that the investor can meaningfully diversify their portfolios with minimum disruption and without sacrificing equity exposure. And this is something we are particularly passionate about at Ironclad. So in conclusion, we believe that trend following might just be the most compelling alternative that investors can use to diversify their portfolios. We believe this because the strategy has delivered attractively high equity-like returns over time, while at the same time offsetting considerable risk, both in bear markets for equities as well as in periods of rising inflation for bonds. Additionally, it's delivered positive returns on average during equity bull markets while being uncorrelated the rest of the time. Finally, because the strategy is now more accessible than ever before, it can be overlaid on top of existing equity exposure, meaning that an investor can diversify their portfolio meaningfully with minimum disruption and without sacrificing equity exposure. If you made it this far into the video, I'd like to thank you very much for your time. We'd be very interested in hearing your feedback or answering any questions you might have about this strategy or any other. I'd like to invite you to follow the link to our website and to get in touch. Thank you, and I'll see you in the next one.